Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter per business and the people that own them. I'm fortunate today to have Jim Ely with me. Jim, in 1984, started doing SBA loans and now owns his own company, SBApro.com, which is a lender service provider that helps banks and borrowers participate in SBA 7A loan programs. Jim works directly with borrowers to obtain SBA financing, helping them to buy or sell a business, buy a building, start up a new business, or grow and expand their existing businesses. Jim also helps community banks set up and run their SBA departments. Since 2004, Jim has led instructors of the SBA application processing class offered by the National Association of Government Guaranteed Lenders. Jim currently serves as a loan committee chair for the Small Business Financial Development Corporation of Orange County, which is the leading financial development corporation in the country. In 2015, Jim was recognized by the U.S. Small Business Administration as their Financial Service Champion of the Year. Jim also sits on the board of directors for a small community bank, California International Bank. So our topic today, Jim, is everything you want to know about an SBA loan but didn't know what to ask. So let me ask you this. What is an SBA loan?
First of all, let me answer by saying what is not an SBA loan. It's not a loan from the SBA. The SBA does not lend money. A bank does, and the SBA guarantees a part of that loan. And as a result of that guarantee, you might be able to get financing you couldn't get otherwise. Which kind of leads somebody to ask, well, what is the SBA? SBA is an acronym for Small Business Administration. That is an independent agency of the federal government. It got started back during the Eisenhower presidency, which is the 1950s. Its stated mission is to be an advocate and supporter of small business, which is the leading employment generator in the country. I think almost 1 out of every 2 jobs are created by a small business in this country. So they're very important to the economic well-being of the country, and that's why the SBA was created. And the constituency for SBA loans is quite strong. It is an agency of the government, and it is a political animal. And to put this into perspective, I got started doing SBA loans in 1984. So what is that? 35 years now, which really all that means is I'm just starting to catch on. But my first week on the job in the SBA world was back when Ronald Reagan was president, and he decided that we didn't need the SBA. He didn't think the government needed to be guaranteeing loans to small business. So he decided that we wanted to abolish the SBA. So my first week on the job is a letter writing campaign to my congressperson, to other influencers, to everybody that I knew to help save the SBA. And sure enough, the SBA was not abolished by Ronald Reagan. The takeaway from that was, well, if Ronald Reagan couldn't kill the SBA, I don't think anybody can. And to this day, the SBA is very, very well regarded on both ends of the political spectrum, no matter, if you're conservative, if you're progressive, or whatever you want to call yourself, the support is broad-based. And one of the reasons being is that, reaches out to small, disadvantaged communities as well as thriving small businesses. And the other neat thing about it that a lot of people don't know is that the SBA loan program pays for itself. And what I mean by that is one of the unique aspects of an SBA loan is the borrower is charged what is called an guarantee fee. And that's a fee that normally is financed, and it's paid by the borrower, and it goes to the SBA. And in theory, that fee is to basically be used as a reserve in case the SBA ever has to honor their guarantee. The SBA has done such a good job as a steward of that guarantee money that the program pays for itself. There is no subsidy from the taxpayer to pay for the SBA loan program. It's all self-funding. It operates on what Congress calls a zero subsidy rate. So it's kind of like a pay-as-you-go. So, as a taxpayer, you should feel good about it. There's no taxpayer dollars being wasted whatsoever. So it's a great program. So that really, in a nutshell, is an SBA loan. It's a loan that a bank or a non-bank lender approved by the SBA will make to a eligible small business, and the SBA does guarantee a portion of that. And notice I used the word eligible small business. A lot of people think small business, what does that mean? Is it the mom and pop store down the way, or is it a home-based business? No. The SBA definition of a small business is net income after taxes of less than $5 million a year. So I don't know about you, but $5 million after taxes is quite a bit of money. So a lot of the businesses that I've worked with over the years have been quite large, substantial businesses. And the reason why SBA likes to reach out to these larger companies is those are the ones that are very instrumental in both innovation in the economy, as well as, more importantly, employment, retention, and creation. So that really is what an SBA loan is.
Now, let me ask you, Jim, what can an SBA loan be used for? Is there any specific thing that you can use it for? Can you use it for multiple things? Or
there are a broad variety of eligible uses of proceeds for an SBA loan. There are two primary SBA loan programs. There's what's called the SBA 504 program, and there's also what's called the SBA 7A program. And if you're wondering why they say 504 and 7A, that just refers to the paragraph in the Code of Financial Regulations where they discuss the SBA program. It's paragraph 504, whatever, or paragraph 7A. The 504 loan program is a real estate purchase program where if you want to buy commercial real estate that's owner-user for a small business, a 504 program allows you to get in with as little as 10% down, and a bank will provide financing in a first trustee position for about 50%, and the SBA issues a debenture for roughly 40% of the total project. So you got 10% down, banks in for 50%, SBA's in for 40%. The benefit to that is that the small business owner is able to retain and preserve cash and working capital by only having to put 10% down. That's one of the main benefits of the 504 program. The 7A program can be used for a lot more purposes. For example, you can buy real estate with an SBA 7A loan and get away with putting as little as 10% down. You can refinance real estate debt. You can refinance other business debt. You can buy an existing business. Let's say an owner wants to retire and sell his business. You can get an SBA loan to buy a business. You can get an SBA loan to start up a business. You can get an SBA loan to get inventory for your existing business. You can get an SBA loan to buy equipment for your business. You name it, you can just about use an SBA loan for almost any purpose. One of the things you can't use an SBA loan for is to pay off taxes. If you're past due on taxes, that is a problem with the SBA. Just kind of the optics of it. It probably doesn't make sense to be using government guaranteed dollars to be paying a government obligation. It's kind of a little one of the quirks there. The primary benefit of the SBA loan program with that guarantee is that, one, you're able to get financing you couldn't get otherwise. Because, lenders look at several things with respect to credit qualifications. Typically, it's going to be management. What's the quality of management? Do these guys know what they're doing? The other is cash flow. Is the business generating enough cash flow to service the debt? And then they want to look at the balance sheet. Is the company in a good financial position? Is it over leveraged, or have they built up some equity in the company? And finally, the last thing is collateral. Is the loan fully secured with collateral, either business or personal assets? And if you're strong in all those areas, you typically don't need an SBA loan. A bank's going to be willing to do that on a conventional basis. But most often, a small business is going to have a deficiency in one of those areas. Like, for example, you don't have enough collateral to secure the loan. The bank is not going to approve it. You can get an SBA loan to offset that lack of collateral. The other is cash flow. Most banks on a conventional basis will provide financing that's amortized or relatively short term. They want their money back as quick as they can get it back. The SBA, though, will allow a longer term amortization. The benefit of that longer term amortization is that your payments are a lot lower, allowing you then to qualify for either more money or money you couldn't get because of the shorter term amortization. To give you an example, the term of the SBA loan, the amortization of the SBA loan, is based on your use of proceeds. Like, for example, let's say you want to get working capital, cash in the bank. You need permanent working capital to expand into a new market. The SBA loan will fully amortize that loan for 10 years. Meaning your payments of principal and interest are based on repayment of the loan over a 10-year term. You can't get that on a conventional basis with that kind of term. If you're going to buy equipment, the SBA loan will amortize that loan over the estimated useful life of that equipment. Typically, it's 10 years. Your other option is you could possibly lease the equipment, but most equipment leases are going to be written over a significantly shorter period, like 36 months, 48 months, as opposed to the 10 years. As a result of that 10-year amortization on the equipment loan, you can buy more equipment or basically have payments that are better suited for your business. And notice I use the phrase estimated useful life. One of the unique niches with an SBA loan is, let's say you want to buy a large CNC machine for your company or a Heidelberg press. What a lot of people don't know is those types of assets, like a Heidelberg press, actually can stay in place and be useful for 25 or 30 years. You can actually go out and get an SBA loan to buy equipment with a 20-year amortization because of that long-term useful life of the equipment. On a conventional basis, your amortization would be a lot less. So your payments are a lot lower. So that's one of the primary benefits of an SBA loan is that longer-term amortization.
You know, Jim, you said something on the 504 that it was 10% down, the bank's picking up 50, and the SBA picking up the 40%. Is it the same on the 7A?
No. The 7A is a completely different animal. It's just one loan that the bank lends to you, and the SBA is going to guarantee somewhere between 90 to 75%. And as a result of that guarantee, where the bank is really only at risk for that unguaranteed portion, they're willing to lend you the money. The percent of guarantee that the SBA provides is based on either the size of the loan or the type of loan. Like, for example, if your loan amount is $150,000 or less, SBA will guarantee 85% of the loan. That means the lender's only at risk for 15% of the loan. They're willing to usually, kind of roll the dice sometimes with a borrower. On loan amounts over $150,000, the SBA guarantees 75% of the loan. If the company is an exporter, and the definition of an exporter is you are selling goods or services outside of the United States, you're considered an exporter, or if you've been adversely impacted by foreign competition, you're eligible for what's called an international trade loan, and the percent of guarantee from SBA on that is 90%. And as a result of that 90% guarantee, a lot of the lender risk has been mitigated. You notice I said adversely impacted by foreign competition. Let me give you an example of adversely impacted by foreign competition. I did an SBA loan a few years back for a gentleman that had a unique trailer to haul motorcycles. He was manufacturing here in Southern California his product, and suddenly knockoffs of his product were appearing that had been manufactured in both Korea and China that were trying to be sold at a fraction of the cost. He was able to demonstrate that he was being adversely impacted by foreign competition, that we were able to get him an SBA loan with a 90% guarantee. And he was able to compete very effectively with that foreign competition, mainly by buying equipment with a longer-term amortization and 90% guarantee. He was able to automate his production line to offset, because the main benefit of foreign competition is typically a lower labor component. And he was able to beat that by getting smarter with his automated production facility. And actually, you're thinking, well, then he probably had to fire his employees. No. What happened is he trained his guys to learn how to computerize the CNC machine, and these guys, instead of being machinists, became almost computer technicians, and he actually ended up hiring more people because of his increased production capability. So that's one example of foreign competition. The other is...
Let me just ask you real quick. When SBA picks up 90%, is the bank, the remaining 10% fall on the bank? Is there anything down by the borrower at all in those cases?
The borrower, remember when I said the things that the lender looks at?
Right.
Are the balance sheet. Well, part of that conversation is what we call equity capital, meaning skin in the game. Does the borrower have any of his own money into a transaction? And the SBA actually requires minimum equity capital contributions in a couple instances. For example, let's say you want to start up a business. The SBA requires a minimum of 10% of your own money into the deal. Let's say it's going to cost you $100,000 to start up your whatever whatever business, SBA is going to require you to kick in at least $10,000. In theory, you might be able to get a $90,000 SBA loan for the difference. If you're going to buy a business, SBA requires a minimum down payment of 10% of that business purchase project cost. And I was deliberate when I said project cost. Project cost is the purchase price of the business plus any permanent working capital you want to finance. So let's say you want to buy $1 million business, you want to have an extra $50,000, so your total project cost is $1,050,000. You would have to put down at least 10% of that. I can't do that math in my head, but
$105,000.
Right. SBA loans can be used in many instances in what a lot of people call leveraged buyout. You can buy a business as little as 10% down. And just to put this into perspective, business acquisition financing is one of the leading uses of SBA 7A loans. If you're an owner of a business and part of your succession plan is to sell the business, you typically will have two choices. Either you can finance it yourself by carrying a note, or your borrower or your buyer needs to get conventional bank financing. Most lenders will not do conventional bank financing unless they have an SBA guarantee.
Is there any cap on the acquisition in terms of the borrowing amount from the SBA?
Maximum SBA 7A loan is $5 million. So you do the math, you can be doing $6-7 million deals to buy a business. And like I said, about 1/3 currently of all SBA loans are being used for business acquisition purposes. Because we're kind of in a wave demographically where you have a whole generation of business owners now that are selling their businesses. Mm-hmm. And you have another wave of young guys trying to figure out what they want to do, and they're buying those businesses. So that's a very active part of what's going on in the SBA universe right now.
Jim, a little bit earlier you talked about a guaranteed fee. So what are the other rates in terms of an SBA loan?
There are a couple different things about an SBA loan. The big one is that guarantee fee. For an SBA 7A loan, that guarantee fee is based on the dollar amount of the loan. On smaller loans, the loans of $150 and less, well, actually it's $125, but I don't want to confuse everybody with the math. Assume on your smaller loans, the guarantee fee is 2% of the guaranteed portion. Let's say you get $100,000 loan and the SBA guarantees 85% of it. That fee is going to be 2% of that 85% of the guaranteed portion. So if you do the math, that's roughly about 1.7% of the loan amount. On the larger loans of up to the first $1 million of guaranteed portion, the fee is, for loans of $700,000 and less, it's 3%. Above that, it's 3.5% until your guaranteed portion exceeds $1 million. And then on the incremental portion over $1 million, it's 3.75%. Now, I'm sure a lot of people's heads just exploded when I was trying to explain that math. But if you kind of do it, it roughly works out to about 2.25% of the loan amount. And keep in mind that is financed. And then you're asking yourself, well, wait a minute. That sounds kind of high in terms of a bank fee. The lender is not allowed to charge any other bank loan fee per se. There's no points or anything else in addition to that. It's just the SBA guarantee fee. And when you think about how you're able to get financing you couldn't get otherwise, and you're probably getting more than you could get otherwise, that guarantee fee kind of makes sense. So that's the big thing with an SBA loan is the guarantee fee. With respect to term, as I'd indicated, your term of the SBA loan is going to be based on the use of proceeds. If it's for working capital, business acquisition, equipment purchase, inventory purchase, business debt refinance, you can amortize it up to 10 years, fully amortizing, no prepayment penalty. If you're going to buy real estate, you can get 25 years fully amortized. And I'm emphasizing that phrase, fully amortizing. That means no balloon. You can take up to 25 years to pay the loan. A lot of real estate loans on a conventional basis will have a balloon payment after 5 years. And then you have to go out and refinance and do it all over again. That's one of the primary benefits of an SBA loan is the fully amortizing nature of it. If the term of your SBA loan is over 15 years, you have a prepayment penalty. And it's going to be based on the outstanding principal balance of the SBA loan, where in year 1, it's 5%. In year 2, it's 3%. In year 3, it's 1%. And then after that, there's no prepayment penalty. With respect to rate, most SBA loans are variable rates that adjust on a quarterly basis, and they're tied to prime, which as of today is 5%, and then the maximum spread that a lender can charge is prime plus 2.75%. So if you do the math, your prime's at 5% right now.
7.75, huh?
7.75. I'm sorry. I think prime's actually at 5.25. It just went down last week. So you're roughly at about an 8% interest rate for non-real estate purposes. Sometimes your rate on a real estate transaction might be a little lower because a lot of lenders like to do real estate loans and they get a little more competitive. Now, if you're thinking, wow, that seems kind of high, 8% for a business loan, keep in mind the loan is amortized over a longer term. So as a result of that longer-term amortization, even if your rate goes up, your payment isn't going to go up by that much because most of your payment is principal reduction and some interest. So you're not impacted that much by escalate. Your payment will go up if rates go up, but it's not going to put you out of business because most lenders are going to stress that rate and say if rates went up by 200 basis points, could this guy still make the payments?
Well, and after 5 years, like you said, if you hold on to that loan long enough, you could refinance it without a payment penalty. So that'd be great.
Actually, after 3.
After 3 years.
After 3 years, if it's a real estate deal. So it makes a lot of sense.
Now, Jim, you talked about experience, the team, the industry, skin in the game. So what are lenders looking for when applying for an SBA loan, in addition to what you've already said?
The hardest part of getting an SBA loan is actually the gathering of the information. If you have an existing business, what you need to be able to provide just to see if you're even in the ballgame is going to be a current business financial statement. And that's a balance sheet and profit and loss statement, as well as your business tax returns for 3 years. That is right out of the gate the first thing the lender is going to want to see. And the reason why he's asking for that is, one, you can really quickly see what the trend in business is. Look at sales year to year. Are they flat, going down, or increasing? And then you can look at the bottom line and see what our cash flow is to service the debt. Cash flow is king when it comes to SBA loans. So that's one of the first things they're going to ask for: 3 years of business tax returns, a current business financial statement. In addition, they're going to ask for a personal financial statement, which is a listing of all your personal assets and liabilities. And the purpose of that is to see what your personal need is, to see if you're paying yourself an appropriate salary from the business, and does everything look kind of good with the big picture. They'll also ask for a little bit of business background, because one of the things is the SBA will not guarantee a loan to somebody unless you're of, quote, good moral character. Now, I don't know what the definition of good moral character is, but the SBA feels they can ascertain that by having you fill out a one-page form where they ask a couple questions on criminal background, to be quite honest. If you've ever been convicted of a felony, if you're currently on probation, you're ineligible. If you've been convicted of a felony, as long as it's single in nature and remote in time, you can qualify for the SBA financial assistance. In addition, you either have to be a U.S. citizen or a legal permanent resident. Now, there are some exceptions to that. They're pretty tough to meet, meaning you still have to have a manager of the business that can reside legally, and you're going to have collateral that fully secures the loan, which kind of obliviates the benefit of an SBA loan, because a lot of SBA loans do not come close to being fully collateralized.
Now, Jim, when you said business tax returns for 3 years, what if you're a startup? Will the personal financial statement be enough?
A startup's a little different. On a startup, what lenders are going to be looking for is, first of all, do you know what you're getting into? That's going to be the very first question. The questions are going to be, do you know what you're getting into? How much of your own skin in the game? Remember, I had mentioned that the minimum equity injection is 10%. Lenders like to see more than that. So they're going to say, how much of your own money you're putting into the deal? Where's that money coming from? And then, have you actually looked at this business opportunity? Have you put together a cash flow forecast and an operating projection or some kind of business plan? You technically don't need a business plan, but it really helps you if you have one put together. We're quantifying, what is this business opportunity? What are you getting into? Who are your customers? What is your projected profit? So for a startup business, you should have an operating projection with narratives, kind of like a business plan, identification of your total project costs. Let's say you want to start up a coffee shop, for example. You should identify your total project cost being the construction and build out of the location, first and last month's lease deposit, initial inventory, having enough working capital to support the business till it makes that transition to profitability. There's your total project cost. And then how much of your own money you're putting into that versus how much are you going to borrow. We need to have that clearly articulated. And then you have an operating projection that shows, hey, in month 1, we might do this much. And then you're going to say, well, wait a minute. Why do you you think you're going to be able to do this much in sales? You got to be able to back that up. Like, for example, you're saying, well, I'm going to sell X amount. Like in the restaurant business, the way a lender will look at a restaurant projection is you do what's called a table count. What's my capacity for table? And then how many tables are you going to turn during the breakfast or lunch or dinner period, what's your average ticket per customer, and kind of go from there. Like a rule of thumb in the restaurant business is it used to be your cost of food shouldn't exceed 30% of your sales, and your cost of labor shouldn't exceed 30% of your sales. What's happening, though, is with the increase in minimum wages and a scarcity of available labor right now, is that labor piece either needs to increase as a cost of goods sold, or you're going to have to increase your ticket item to adhere to that 30%. Right now, I'm seeing labor is getting closer to 35% in the restaurant business. So you need to have a projection with narrative assumptions that addresses that if you're trying to start up a business. Now, I'm going to throw it out here. I don't know if you want to be starting up a restaurant right now with an SBA loan. The climate with the lending community for a restaurant startup is very tough right now. Unless you have a following, you're a chef, you might be able to do it, or maybe if it's franchise, where you have the track record of the franchise. Otherwise, most lenders are going to have a real issue trying to do a startup franchise. A startup restaurant. Very, very difficult to deal. And then finally, the last thing, the ideal startup is you have a working spouse whose income is sufficient to help support the household. So the money you need to pull out of your startup isn't that great. Then ideally, you do have some collateral that will secure a good chunk of the loan. You have equity in a house. You need to offer the house. Just to put this into perspective, SBA on all SBA loans require a personal guarantee. And the question or the issue is that personal guarantee unsecured or secured? And what I mean by secured, there is the possibility that the lender may require a second deed of trust on your house if you have sufficient equity in the house. And the guidance with SBA is if the business assets do not fully secure the SBA loan, then we need to take a second on the house if the equity in the house exceeds 25% of the market value. So if you have a house worth $500,000 and you owe $300,000 on it, the SBA is going to want to take a second on the house. When we look at business assets, the SBA looks at what they call liquidation value. Coming up with that, remember I said if the loan isn't fully secured with business assets, their definition of fully secured is we look at the liquidation value of those business assets. So for example, we look at your equipment and we're going to look at the balance sheet, and whatever the net book value of that equipment is, SBA is going to say, well, if we had to sell it because you go out of business, we'll be lucky if we get 50 cents on the dollar. So you're going to take 50% of net book value of your equipment. So most SBA loans are not fully secured with business assets. So then we're going to turn to you personally, and they're going to say we want to take a second on the house in most cases. And a lot of people will come back and say, well, I can't do that. My wife won't let me. And the challenge then is we're asking the lender to try and believe in us, yet you don't believe enough in yourself that you're willing to put the house on the line. So it's kind of a thing. Lenders like to see you putting everything on the line. And right. You should be prepared to do that if you have significant equity in your house being greater than 25% of the market value. If you don't have equity in your house, don't despair. The SBA loan can be done as long as we have cash flow and
as long as it makes sense. As long as it makes sense.
Yeah.
And I want to ask you, Jim, other than getting hold of you, how do you get an SBA loan? How do you go about getting one?
Remember what I said. The SBA is not the lender. A bank is a lender.
Correct.
So you need to find out who's an active SBA lender. And the SBA themselves, local district offices, have lists of active SBA lenders. But then the challenge is, who do you talk to at the bank? Some banks have dedicated SBA departments with what they call a business development officer. Other banks, they just have a back room where they process the SBA loans. So the secret is knowing who to talk to. If you're going to approach a bank, ask them if they have an SBA department.
Are these the bigger banks or the smaller banks or all banks?
Not all banks are SBA lenders. I spend a lot of time, one of the hats that I wear is I help community banks set up and run their SBA departments. And these are banks that want to become an SBA lender. They just don't know how to get into the business, or they just don't have the inclination or the resources to start up that department. So I help them start up that department, and then I get it up and going. And then what happens is they're really anxious to do an SBA loan. And then they'll ask me, hey, do I know anybody that needs an SBA loan? And the neat thing about it is the bank pays me a fee that's out of their own pocket. That's not passed on to the borrower in any way. So it's kind of a win-win for everybody. The point I'm trying to make is if you're a borrower and you're looking for an SBA loan and you meet somebody that says he can help you get an SBA loan and he doesn't work for a bank, do not pay him any money up front. You don't need to do that. Most people will be compensated by the bank, and that's a fee that's not passed on to you as a borrower. If somebody's trying to charge you money up front to get a loan, I'd be very careful, because there's no guarantees you'll ever get the loan until you get something in writing from the bank. I'd be very careful about that. So, if somebody's interested in an SBA loan, I'm more than happy to deal with them directly, or they can go to their own lender. The big banks, here's the thing. Big banks are very formulaic in their lending. You got to kind of fit in their little cookie cutter box.
Right.
And what I have found is most small businesses don't fit in that little cookie cutter box. So you're better off going to the smaller community banks. And here in Southern California, where I'm located, we have quite a few small community banks, several of which I've helped them start their SBA departments, and I have an excellent rapport with upper management at those banks. He's our chief credit officer of the bank, where I can call up and say, hey, Eric wants to start up a coffee shop. And they can tell me yay or nay right there on the phone, and then I can encourage you to get me more stuff, and away we go.
Anything, Jim, that I left out or you might want to answer?
Don't think of an SBA. A lot of people turn up their noses at SBA loans thinking that they are for little piddly companies like a startup, or they're small loans like a $25,000 loan. No, remember, I told you, the maximum SBA loan is $5 million. So don't overlook that. If you're looking to buy a building for your company, you should seriously consider an SBA loan, because you can get into it with as little as 10% down. And the other thing that I've noticed over the years is if you're a business owner, you've got a lot of pressure just to make ends meet sometime, make payroll, make rent. And next thing you know, you blink and 15 or 20 years have gone by. And what do you have? You have this business. And then your succession plan is maybe sell the business. If you're able to buy your own building and you need a facility anyway from your business, that becomes a very integral part of your retirement nest egg as a business owner, because you're paying for that occupancy cost anyway. And if you look at the numbers based on what it takes to rent a place versus what it takes to finance it, it's a pretty even proposition, but you end up owning your own building after 25 years.
You got an asset.
You got an asset that can either produce income or you can sell it. So that's the one thing, is think of an SBA loan as a tool to either help grow and expand your business, or as a tool to help grow and expand yourself personally, like buying a building. And the other thing is, if you're a business owner right now and you're having trouble making ends meet because of your debt, you could seriously consider refinancing your business debt over a longer term.
Right.
Like, let's say you went out and you bought a piece of equipment a few years ago and it's amortized over 3 years or 4 years or 5 years. I can come to you and say, hey, I can get you an SBA loan. It's amortized over 10 years. So your payment is half of what it used to be.
Right.
And that's the one thing is in the economic cycle, the nature of deals that I look at changes over time. Like when things are good and business is growing, what I'm finding is that I see a lot of startups. Mm-hmm. I see a lot of business acquisitions. I see a lot of working capital requests and things like that. As the economy starts to slow, I start to see more business debt refinances, more business acquisitions. And so it kind of just depends on where you're at as a small business too. Don't overlook with an SBA loan things you can do. It's really a bank loan. It just happens to be for a longer term, or maybe for more money than you thought you could get.
Well, Jim, thanks for being with us today. Thanks for the people who listened. You can always get hold of Jim directly, or you can email me at eb@wait-what.biz. Thanks, Jim.
Thank you.